The disruption is already here. It is not coming next quarter or next year. It's here today and it is visible in the earnings numbers of some of the biggest names in Indian IT. The first quarter of FY26 has thrown up a revealing contrast between two tech giants from the same group, TCS and Tata Elxsi, and both in very different ways are feeling the pressure of a changing global technology landscape. Before we go further, if you're new here, I am Pranshumaan, a former investment banker turned financial educator. I break down complex market and business shifts into sharp, data-backed narratives for long-term investors and serious learners. If you like this kind of content, make sure you subscribe, join our Telegram group for deeper discussions, and share this video with others who are tracking Indian IT. Now let's talk about what's really going on beneath these Q1 numbers. Let's start with Tata Elxsi. Now, this is a company that until recently was treated almost like a premium product in the IT portfolio. High margin, R&D heavy, and deep in auto and healthcare. But Q1 FY26 shows clear signs of stress. Revenue has shrunk sequentially by nearly 2%. That alone may not seem dramatic, but the real story lies in the margin slippage. EBITDA and PAT have dropped steeply on a like-to-like basis. The company's margins are slipping, with EBITDA now at 20% and PAT margins falling to 15%. Now, this is not a one-off. This is the continuation of a trend that began a few quarters ago. TCS, meanwhile, is holding the fort. Its revenue grew a measly 1.3% year on year, which is not impressive but respectable in a difficult environment. Net profit rose to 12,700 crores and operating margins were steady at 24%. Now, these are still industry-leading numbers, but even TCS is not immune to the broader slowdown. Total deal bookings were sharply down compared to last quarter, falling from 12 billion to 9.4 billion. For a company like TCS, that is not a small miss. To make sense of this divergence and the overall sluggishness in the market, we need to zoom out and look at the three big macro trends that are reshaping how global clients are engaging with Indian tech service providers. The first is the growing uncertainty in the US market, especially around trade and tariffs. The US remains the single largest market for both TCS and Tata Elxsi. But in recent quarters, global companies have become increasingly cautious. In Elxsi's case, the healthcare and life sciences segment shrank by almost 7% this quarter, and management directly attributed that to tariff-related uncertainty. Medical device firms in the US have either paused or scaled back engineering programs, and this is hitting Elxsi's top line. TCS has also seen some pressure on this front. While its large client base gives it more stability, discretionary IT projects in retail, auto, and travel have also slowed down. When geopolitical risk rises, clients delay spending and that is showing up in the order book. Deal wins are still happening but not at the pace that the market had gotten used to over the past few years. The second and more structural trend is the AI overhang. Even if AI has not directly disrupted service providers yet, it is already disrupting client behavior. Across industries, clients are choosing to pause their traditional IT budgets and instead allocate resources to IT experimentation. For Indian IT companies, that translates into a slowdown in deal closures, especially for transformation or R&D related work. Clients today are not asking how fast we can build this, but they're asking, should we build this at all, especially if Gen AI changes the underlying assumptions in 6 months? Now that hesitation hurts Elxsi more than TCS. Elxsi thrives on high-end R&D work, connected vehicle interfaces, AI-powered diagnostics, advanced media platforms, and other high-tech technology work. When budgets shift towards short-term POCs and internal pilots, vendors like Elxsi take a hit. TCS is better cushioned thanks to its sheer size and breadth, but even it is starting to feel the effects as AI begins to cannibalize traditional IT budgets. The third and perhaps the most underappreciated trend is the rise of global capability centers or GCCs. These are India-based captive tech hubs set up by global corporations. A few years ago, the same companies would outsource large chunks of work to TCS or Infosys. Today, they are building their own teams in Bangalore, Hyderabad, and Gurugram, often poaching talent from the same pool that these IT firms relied on. GCCs offer better cost visibility, tighter IP control, and full integration with the internal roadmaps. For a long time, Indian IT companies were the default mode of delivery, but now global firms are realizing that if they have enough scale, building their own centers is not only cheaper in the long run, it also gives them more control. This is not just a blip. This is a structural reallocation of value away from outsourced IT towards captive or in-house teams. And it's visible in the shrinking size of large client wins. TCS's order book weakness is not just about short-term caution, it is about long-term disintermediation. So taken together, these three trends, US trade uncertainty, AI-led hesitation, and GCC-driven insourcing form the backdrop to the subdued performance that we are seeing in this quarter's results. But this is not the whole story. Let's talk about valuations now. Tata Elxsi is down over 35% from its peak. Now, this was a stock that used to trade at over 100 times earnings at one point. Today, it is under 50 times. Still expensive by most standards, but far from the frothy levels that it used to trade at. For investors who sat out the rally or who booked profits, this feels like a reset. Whether it becomes an opportunity depends entirely on how the business responds to the headwinds. TCS, meanwhile, is trading at under 25 times earnings, the lowest valuation band that it has seen in the last 5 years. The dividend yield is inching up, free cash flow remains strong, and the company has not yet made any drastic headcount additions. If anything, it is flat hiring trend that is suggesting a deliberate attempt to extract more output from the same base. Exactly what you want to see in a cycle where margin preservation matters. But valuations alone don't justify buying. We have to ask what would make these businesses outperform again? What are the early signs of a turnaround? And what should we be watching for in the next few quarters? There are a few key signals to track. First is a deal pipeline, especially large deals, anything above $50 million. If we start seeing momentum return in North America and Europe, particularly in areas like BFSI, healthcare, and auto, that would be a green shoot. In the case of Elxsi, even one or two large deals in healthcare or media could swing the quarterly numbers dramatically. Second, watch operating margins, but not in isolation. The important detail is whether margins improve without a corresponding rise in headcount. Now, that would tell us that companies are using automation, AI tools, and better resource allocation to drive productivity rather than simply hiring their way to revenue. Third, track the productization of AI. Not just POCs and slide decks, but actual billable AI enabled services. If Elxsi, for example, launches diagnostic toolkits for medtech clients or SDV modules for automotive partners, that would be a sign of adaptation. Similarly, if TCS starts integrating Gen AI into its delivery at scale, not just as a service but as a platform, it could become a new margin level. And fourth, the recovery of weak verticals. Healthcare and media were the worst performers for Elxsi this quarter. Any signs of sequential growth in these areas would suggest that client budgets are loosening up and confidence is returning. In TCS's case, BFSI remains the bellwether. If that vertical picks up, it usually brings the rest along with it. And finally, we need to watch whether Indian IT finds a way to partner with GCCs instead of being displaced by them. That could mean offering infrastructure support, building tools for internal dev teams, or even co-developing platforms. If that narrative takes shape, it could be a new growth engine that sustains margins even if traditional outsourcing slows down. To sum it all up, this is not yet a buy the dip moment for Indian IT, but it is very likely the beginning of a valuation reset that will separate winners from laggards. TCS and Tata Elxsi still have the DNA to adapt, but the days of easy growth are behind them. What lies ahead is execution heavy, margin sensitive, and structurally different from the past decade. So the big question is, are these stocks a buy, hold, or sell? Drop your views in the comments. I'd love to hear from you. And if you want to join others who are tracking these signals and discussing them in real time, join our Telegram group. The link is in the description. And of course, if you found this helpful, hit the subscribe button, share this video with a fellow investor, and stay tuned for more breakdowns like this. Until next time, stay informed, stay invested.